So, all right, we got another rate hike. We're obviously still concerned about the regional banks. What's your view here?
My view is simple in that the risk-reward for equities and risky assets remains unattractive. I think you have basically three disconnects in the marketplace. One is equity bonds, where bonds seem like they're onto something, smelling weakness. Equities so far have been cheering sort of the fall in rates and a pretty hefty rotation into growth stocks. Two, I think you got a bit of a disconnect between Wall Street and Washington, D.C. when it comes to the whole debt ceiling topic.
That's an understatement.
Yeah, investors so far not really bothered by it. And then, geopolitics, a tough one to call, but things are not easing, but no one cares.
So even if the Fed, let's just say the Fed's done, okay, for argument's sake, the risk reward is still not improving.
If you look at the past cycles going back 50 years, 60 years, market was typically a good short, either right at the last hike, i.e. potentially that was yesterday, or at the first cut, which could be in 3 months, could be in a month, could be in 6 months. And so it's a question of how do you think about that potential lag. But that's what history suggests. And to me, I think the picture is, when I think bigger picture, the fact that you got an earnings cycle that remains under pressure, you have a market that is trading already at a relatively high multiple with a lot of these good mega cap tech stocks pretty crowded, very narrow leadership, banking crisis, which maybe parts of it are fixed, but maybe parts are not. And the fact that central banks are still sort of hiking it, it's not just the Fed, but also ECB, I think it's just a very tricky outlook. It's
sort of a whole group of issues which, I'm not surprised to hear you talk about. A lot of people are, including Jeffrey Gundlach, who I spoke with yesterday. Let's listen to what he said as to why he's turning more bearish.
I'm really turning more bearish at this point in time. I think the markets for risk assets are too complacent, given this cocktail of higher interest rates, quantitative tightening, and credit contraction. Certainly, we should expect higher default rates in lower quality fixed income securities as we move into the end of this year. And I'm strongly of the opinion that investors should be going up in quality in bond portfolios.
What do you think of that?
No, I fully agree with the term, especially complacent. I do think there's complacency building, and if you look at various parts of the subprime market, whether it's credit card or auto loan or multi-purpose loan, you're definitely seeing more and more cracks and delinquency rates moving higher. You have the whole question mark around commercial real estate office. I believe there's also some complacency perhaps in the multifamily resi side, because supply is coming online in some of the states in a big way. And you're going to ask the question, what are these developers going to do with all these employees and workers, right? And you saw some of the construction numbers or construction workers actually not moving in the right direction. You're seeing some layoffs there. So it's a tricky backdrop. Cost of capital being elevated for such a, first cost of capital going up at such a fast pace after we were at, 0 or 1% for so long, and then persisting at these higher levels, I think that's just creating a whole suite of problems. And we don't know exactly where the risk is going to pop out, but I kind of say the risk of unknown unknowns is simply moving higher the longer we stay at this sort of higher interest rate level.
We talked to Leisman, was with us a few moments ago. Market now pricing in a 60% chance of a cut by July. Is that a negative or a positive if that happens?
I think once that happens, I would argue it's a positive.
Oh, yeah?
But the problem is, what's the, call it, pain threshold for someone like the Fed, for someone like Powell? And we're not there yet. So you still have, between now and then, and in the meantime, you could see a lot of headline, a lot of volatility, a lot of pain. So I think once you get to the point where you start seeing signals that the Fed is definitely looking to cut and ease, and then the regional bank side, the business model starts to make more sense, then I think you start getting some relief. But we're not there.
So Gundlach likes longer dated treasuries, still likes Europe over the U.S., emerging markets okay, he's been buying gold. What's the Dubravko playbook look like right now? So
our playbook on the equity side has been generally tilting towards the defensive trade, defensive sectors. I think on a day like today, on a day like even yesterday, you're paid to be long utilities. Healthcare, especially the more defensive parts of healthcare. Again, these are defensive sectors. That's what I would be leaning into. And when I look at a lot of the data, I don't think the market is pricing in a recession. And so I think this rotation from cyclicals into defensives is only 35, 40% at most underway, and more rotation to continue in that direction. So in other words, I think the defensive trade will become a lot more crowded than what it is right now as we get closer to an eventual contraction.